The MACD is one of the simplest and most effective momentum indicators for forex, stock, and crypto trading. The MACD turns two trend-following indicators, moving averages, into a momentum oscillator by subtracting the longer moving average from the shorter one. Exponential averages are used because they respond more quickly to changes in price, since more weight is placed on the most recent price compared to the earlier prices. You can use any length of period you wish when calculating the various exponential moving averages, although the 12, 26, and 9-period moving averages are most frequently used. Hey guys, welcome back to another episode. In this video we will be going through our MACD indicator trading strategy in depth and how we use it in combination with price action. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. MACD indicator can be used for scalping, day trading, and swing trading strategies. To understand how the MACD can be used in trading, you first need to know how it works. This chart shows the relationship between the two moving average lines and the MACD for British pounds United States dollar. The top part of the chart contains the 1-hour prices for the currency pair as well as a 12 and 26 exponential moving average. The bottom part contains the MACD line, the signal line, the histogram and the zero level. Three things stand out from this chart. First, you can see that as the two moving averages move away from each other, the MACD line rises or falls. Second, you can see that when the two moving averages cross, there is a corresponding crossing of the zero level by the MACD line. Third, when the signal line and MACD line averages cross, there is a corresponding crossing of the zero level by the MACD histogram. What I personally like about the MACD trading strategy is the indicator has a built-in filter for trade signals. This filter is easy to apply to any chart. If the MACD is below the zero line, do not open any long positions when the MACD below the zero line. Conversely, if the MACD indicator is above the zero line, do not open any short positions. So, how this indicator works? When the MACD indicator is plotted on a chart, the most important aspect is the interaction between the two lines as well as their positions relative to the zero line. When the MACD line is above the zero line, it indicates that the shorter period moving average is above the longer period moving average, which in turn indicates that the market is bullish. When the MACD line falls below the zero line, the shorter period moving average is less than the longer period moving average, indicating that demand is more bearish than it was in the past. If the fast line is above the slow line, MACD histogram is positive and plotted above the zero line, suggesting a bullish bias. On the other hand, if the fast line is below the slow line, MACD histogram is negative and plotted below the zero line, indicating a bearish momentum. In general, MACD indicators are used in one of three ways: crossovers, overbought-oversold conditions, or divergences. The MACD is seen as an effective indicator, especially in trending markets. The MACD crossover occurs when the MACD line and the signal line intercept, often indicating a change in the momentum or trend of the market. A sell signal is generated when the MACD crosses below the signal line, and a buy signal is generated when the MACD crosses above the signal line. In addition, the locations of these crossovers in relation to the zero line are helpful in determining buy and sell points. Bullish signals are more significant when the crossing of the MACD line over the signal line takes place below the zero line. Confirmation takes place when both lines cross above the zero line. Here are some examples of MACD crossovers trading strategy. Just like moving average crossover, using the MACD in this way makes it a lagging indicator, which means that it makes use of previous price action data. The MACD crossover is a great tool to use in trending markets, but it is risky to trade with the expectation that a crossover will occur as trending markets are prone to periods of high volatility. Both the MACD and moving averages are intended to keep you on the right side of the market. On the long side during uptrends, and on the short side, or out of the market altogether during downtrends, meaning you buy and sell late. While you may enter a trade after the beginning of a trend and exit before the trend comes to an end, I would use this indicator as a buffer to reduce risk, not as the main signal. Still, price is the ultimate indicator, with momentum indicators simply manipulating price data. Use price action to aid decision-making when using the MACD. Now, can MACD be used for overbought and oversold levels? As a trader, being able to identify overbought and oversold market conditions can help you determine when to enter and exit a trade, what position to take, and when a trend reversal may be imminent. This insight allows you to manage risk and make more informed trading decisions. An overbought condition may exist when the price has experienced a significant upward move. At some point you expect that the price might fall and return to some more normal level. Likewise, when the price has seen an extended downward movement, an oversold condition may exist. At some point the price may be expected to rise to some normal level. A security or index may be overbought when you see the MACD rise significantly. During this period, the shorter moving average used in the MACD calculation is rising faster than the longer moving average. This is an indication that the price is overextending itself and, at some point, may reverse its course. As a centered oscillator, the MACD has no set graphic range. Because of this, it is incapable of providing precise overbought and oversold readings. Unlike other oscillating indicators such as the RSI, there is no predetermined overbought or oversold condition. High and low MACD levels are relative, depending on the security or index you are examining. You may need to study the behavior of the MACD over time before you can determine when the price is overbought or oversold. When using the MACD to identify periods when a security or index is overbought or oversold, the best buy signals come when the MACD line and the signal line are below the zero line, as the security or index may be oversold. Sell signals are generated when the lines are above the zero, where they may indicate an overbought condition. Looking at the MACD behavior over an extended period of time, you may be able to discern patterns where the MACD may rise or fall to relatively similar levels, at which point the price will fall or rise, respectively, and with it the MACD lines. The third popular use of the MACD is to identify those times when it diverges from the price. MACD divergence is discussed in most trading books and frequently cited as the reason for trend reversals or why a trend could reverse. In hindsight, divergence looks great. Many examples can be found where a reversal was preceded by MACD divergence. A divergence occurs when the trend of the price does not agree with that of the indicator. In other words, an indicator trends in one direction while the price goes another or does not go in the same direction. MACD divergences tend to preface a reversal in the current price trend. Bullish divergence occurs when the price is making lower swing lows while the indicator is making higher lows. It is meant to show that selling momentum is slowing and that the downtrend is more susceptible to a reversal. Now, how to use effectively the MACD divergence strategy. In this section, you'll learn to implement the MACD divergence indicator much more effectively. This is one of the most powerful trading strategies to use. You can use the MACD histogram to search for divergences, but also the MACD line and the signal line. The strongest signals appear when there is a double divergence on both the histogram and on the signal and MACD line. This is my favorite way to use the MACD and the most effective way. Trading MACD divergence, if done correctly, can provide you with a real edge in the market. It can be a powerful early indicator of trend reversals when combined with price action. Here are some examples of double divergence. Now, regarding time frame. What is the best time frame to make the most profit from trading? The answer is, this will be completely down to you, your personal preferences and trading plan. However, 1-hour signals are more significant than 5-minute signals, just as 4-hour signals carry more weight than 15-minute signals. One common technique is to track the behavior of the MACD on 4 hours basis. However, instead of entering or exiting a trade based on a 4-hour signal, you could refer to the weekly chart to see where the MACD is. For example, if you receive a buy signal from the 4 hours MACD and you see that on the weekly chart the MACD is in a bullish condition, you may wish to enter a long position. However, if the weekly MACD is in an overbought condition, you will probably want to ignore the buy signal from the 4 hours MACD. As always, if you learned something new, make sure you subscribe, click the notification bell, and leave us a like to show your support. See you next time.